Welcome to Helpline. I'm here to answer your questions again. And last week we changed our method of getting your questions because I do this, I try and answer your questions alone here from my home. And it was getting little, I was unable to focus on answering your questions well while the questions were rolling at a very fast pace. I did not want somebody to it was not possible to do a screening of questions on a live basis. A lot of questions were getting repeated. So now the new way of posting your question is that come to Value Research Online, put your questions there, and once you put your question, if I'm answering it, or if there is another way in which we can answer your question, then you can see it in your account at Value Research Online. You can look at your specific question, answer to your question will be visible there. So it becomes more useful. You can actually go back to the question time and again with a deadline that what you asked a question and when and in what context it was answered. So it also remains in your record. So let me start the series of questions this week for you. Anant Garg is asking that in many of our, yes, this is a question which I remember, many people ask this quick opinion. In many of your videos, you recommend balanced fund for newbies and retired person. What exactly is this balanced fund? After SEBI's recategorization in October 2017, is it the balanced advantage fund, or is it the balanced hybrid funds, or is it aggressive hybrid funds? Kindly explain in detail. The quick answer to your question is that these are aggressive hybrid funds as per new classification. And why it comes to why I wrongly tell you that it's balanced fund, because that is how I've been calling them for last 15-20 years. Initially the rule, and these balanced funds have evolved. Ideally, I would have liked to I would have liked to recommend you balanced hybrid funds, but in India, all the balanced hybrid funds available today are of absolutely different kind. They are not truly balanced. They come with some rider or the other. They lack the track record and also the tax inefficiency of that. So the way in last 15-20 years the balanced funds have evolved is that initially these balanced funds were actually balanced fund, 51% equity, 49% debt. But sometime 10-15 years back, the laws changed that for a fund, and they were treated like equity fund. And for them to be treated like equity fund, the laws changed that the equity allocation must be 65%. So every fund actually changed its mandate, revised its prospectus to have 65% into fixed income, 65% into equity, so that it is entitled for the tax benefit that was available to equity, which is completely exempt from capital gains. And once it happened, it was very difficult to run at a sharp 65%. So everybody kept a broad range of 65 to 75%. 65 to 75% range actually made it almost like a quasi-equity fund. And but they continue being called as balanced fund. That is why I continue to call them as balanced fund as a matter of habit. I'll try and be right with the nomenclature from here on, which is they are aggressive hybrid funds which I refer to. Why I refer to them? Because mostly people are asking for a recommendation, a quick recommendation for the long term for investing in equity, and I don't think anybody who has not been exposed to any market linked investment should start with an all equity fund. So these funds turn out to be relatively steadier take on growth. They grow steadily relative to an all equity fund. They don't crumble when the markets fall freely, and so it becomes little convenient or relatively easy for new investors to get started with an equity fund. So after all this long answer, the answer is that all long-term investor, first-time investor should start with aggressive hybrid fund, which is about 75% equity, 25% debt, active rebalancing, treatment like an equity fund, and gets you growth without the kind of volatility or extreme volatility that we see in equity. Akhil Raj is asking that is there any tax benefit if a married couple divides their mutual fund investment in both of their portfolios? Investments in both of their portfolios. Yes, there could be a small advantage. Ever since the capital gains tax has been clamped on equity funds, there is a benefit for having multiple accounts. Like everybody is entitled to 1 lakh rupees tax exemption. If you have an annual capital gains tax of 1 lakh rupees on your 1 lakh rupee investment, that is exempt. Subsequent to more than over 1 lakh rupees, you are liable for 10% capital gains tax. So if you split your investments, two people will be entitled. You will be entitled for 2 lakh rupees, 1 lakh rupees each. So if you are investing and at some future date you want to realize your gains, you will be entitled for a larger capital gains tax exemption by splitting into two accounts. So yes, there is a benefit. Rajesh Alim is asking that what are your thoughts on the stamp duty imposed on buying and selling of mutual funds? Do you have to pay tax when we redeem them in our gain if our gain is more than 1 lakh? Is it not double dipping the taxpayer? Let me just get you the facts and then the opinion, which is, do you have to pay tax when we redeem? No, this is the stamp duty. The stamp duty is payable on any asset that you buy. So when you buy a land or an apartment or anything, you pay the stamp duty to the state government. This is that stamp duty. It was not possible to implement it seamlessly in the securities market. Now it has become, because of all the automation or the way the securities market is organized today, it is possible. It was not implemented so far because the stamp duty was not standardized across different states. Now it has been standardized. It is 0.005% on all the securities. So if you make a 1 lakh rupees investment, 5 rupees will be paid by way of stamp duty, and this has nothing to do with your capital gains tax or anything. That is a central tax. This is a new tax imposed on mutual fund purchases, and it is only at the time of purchase. All kind of securities, shares, mutual funds, and so it has nothing to do with it. What are my thoughts on stamp duty imposed on buying and selling in mutual funds? It is not a matter of opinion. Of course, I don't like it. But it doesn't matter. It is a law, and as law-abiding citizen, and there is no way you can avoid it. You will put your 1,000 rupee and some 50 paisa will be deducted, and the rest of the money will be invested. This is imposed on the mutual fund, and it will be charged on the mutual fund exactly like the entry load. Yes, the magnitude is very small, but once such a normally governments find us try to test the water, and they are trying it in a small way. Once they find that it is a very meaningful way and very effective way to collect taxes, maybe the percentage goes up, and that will be very disheartening. It definitely is 5 rupee less getting invested on account of the stamp duty. I don't like it, but we don't have a choice. Arvind is asking that I have purchased Best Funds 2020 book. These funds were probably evaluated in December 2019. Considering COVID and Franklin fiasco, when will this book be reviewed and an updated edition released? We review the list every quarter, and the update to different categories actually gets reflected. We are looking at the list of funds that we have recommended. Normally, these are the analyst choice that you find in a feature which is in every issue of Mutual Fund Insight. So every category gets periodically reviewed, and any exclusion or inclusion from that list gets reflected there, and the whole edition gets updated in October 2020, and we reviewed the list recently. We looked at the funds very closely. Fortunately for us, there is not a need for. There are one or two small changes which we would like to make, but there is not. I don't see the need for any big change here. In fact, we turned very conservative. We got very scared with our fixed income selection even before the whole crisis started, because the crisis started long before in a nominal way, and that was very scary. And it is all turning out to be true gradually, not all of it. So we got very conservative. We erred on the side of caution. Many fund companies and investors asked us that, why in our fixed income we only have 9 funds, 4 short term and 2 liquid and overnight fund and 2 equity savings fund for income investors. We became very conservative, and that has come in handy. We don't need to review the list. Our view continues the way it was, and there isn't a need to, of course, following these recommendations, you'll be deprived of some return, because there will be other funds which will be giving you more return as compared to the ones which we have recommended, or the selection that you have here. But I think one should right now, given the current weather or climate in the market, or the economic outlook that we have, or the outlook for various businesses which borrow money, and these funds invest in their fixed income issuances, which is the bonds. I would say that it is better to still remain very cautious, and these funds will actually give you lower return, but your principal is far better guarded and safer with our current selection. So give up on little, it is better to compromise on some return and put your principal at stake, which we have learned the hard way after this Franklin experience. Ashish Jain is asking that, is it better to replace aggressive hybrid funds with NPS Tier 1 with 75% equity for long-term wealth creation due to the low expense and tax benefit? Please advise. Yes, if you are sure that, because within NPS, there is also, one is that of late it has become possible to have 75% allocation to equity. The other advantage of NPS is that even if you want to, or even if you have emergency, you can't take it out. So it enforces a kind of discipline which many investors lack. Third is that, within NPS there could be variation in performance, but you can move the money around. You can move the money from one equity fund to another equity fund to another equity fund. So you are not getting stuck anyway. The only way you are getting stuck is that you can't take your money out till your retirement, or on those exceptional needs that can be there. There are 3 occasions on which, 3 times in a life before retirement, you can take your money out from NPS too. So yes, it is promising, but I still feel that, NPS is not being valued on, or being evaluated on performance. And performance is coming out very sharply. So if you're an index fund investor, I would say that yes, go for NPS. But I still feel that, there will be some great multi-cap fund, and they will beat the NPS by a wide margin. But NPS also looks very promising, because I think, going by the lower expense, NPS funds as compared to a large and mid cap fund or a large cap fund will always figure, because of the cost advantage, will always figure as a second quartile fund if we compare it among mutual fund universe. So NPS is improving and has become attractive, and you just have to worry about that you are willing to compromise on any interim liquidity or substantial interim liquidity by investing in NPS. Meera Berry is asking that, could you please explain for my better understanding as to why some mutual funds, regular schemes, have better star rating compared to direct plan of the same schemes? HDFC Index Nifty and IDFC Nifty Index Nifty are examples. Yes, I was looking for an opportunity to explain it, and your question has prompted me to answer it. The way you choose a mutual fund is that we rate the mutual fund differently. The rating of mutual fund is for a category, and all the direct funds are evaluated together, and our mutual fund rating system is a relative rating. When you see a 5-star, it's a 5-star fund in its own category and relative to all other funds in the category. So 5-star fund or a 5-star fund and a 4-star fund, that the 4-star fund has generated lower risk adjusted return as compared to 5-star funds. And before we do this segmentation, we segregate, we rate the regular plans differently as a unique set as compared to the direct plans, because that is how investors actually go about choosing one. Either you are being sold a mutual fund by an intermediary, or you are evaluating the fund yourself and then you are only looking at the direct plans. And the universe of the regular plan because of the expenses, the risk adjusted performance on a relative basis of regular plans and direct plans can be different. That is why there is a possibility that a 5-star fund on the regular, there could be a regular plan which is 5-star, a regular plan of a mutual fund which is 5-star, simply because it is better as compared to all other funds in the category. The direct plan of the same fund can have a lower as compared to all other direct plans of the same category. So it is comparison among direct plans of the same category and regular plans of the same category. And that is how investors are choosing. You are either choosing from a bunch of, or the universe of direct plans, or you are being chosen or being served a fund from the regular plans. And because of expenses, the relative standpoint or relative performance of the funds compared to other funds in the category can vary. That is why this difference. Bhaskar is has asked this question: what is the easy approach to select an investment for a layman not knowing enough to get into very detailed study of fundamentals? One, buy a mutual fund, and after that, before that, first decide that what is the time period of your investment. When are you likely to need this money? If it is 5 years and more, then answer another question: are you investing for the first time? If so, then invest in a mutual fund. If you have a lot of amount to invest, spread that money over 12 to 15 months or 18 months or 2 years, depending on the scale of investment. If you are going to start from your regular income, then do your SIP. This is the simple way of doing it. If you are asking about how to go about choosing stocks without getting into too much of fundamentals, I think investors who are averse to looking very closely at stocks and companies and are not interested, they don't have the time, they don't have the inclination, they should keep away from that. It is undesirable for investors who are not interested to get into an area which requires a great deal of interest and will cause a great deal of anxiety. Indranil Haldar is asking that I do not need a distributor anymore and can invest on my own. What are the pluses and minuses of shifting from regular to direct plans in the same fund? How do I do that? Is this beneficial? The plus is that you will save little small money, and that can translate into something significant if you are going to remain invested for a very long period. So on a 15-20 year period, 0.5% to 1% higher return as compared to the regular plan, which is on account of lower expenses, is the plus. The benefit is that if your advisor was a friendly guy, was a useful guy, was able to advise you, was able to give you reaffirmation, then that will be a loss. You will not be entitled to that thing. Other thing is that if your investments are still old paper and you still need to, if you are not a very well organized investor, then that advisor also used to, or the distributor used to take care of the paperwork, or will do the legwork for your redemptions, or some change of mandate, or change of address, or change of nominee. You will have to do all these things yourself, and all these things have become relatively easy and can be done online, digitally, much more efficiently. You will be in far greater control. So if you're a well organized investor, you can do without it. By all means, go ahead and do it. How to do it? Two things to be conscious of. One is that it translates into movement of money or change of money. Your investment from regular to direct plan amounts to redemption and a new investment. And it can be done through all the new platforms that have come up. And you can also make a request with the fund company to move your money from the regular to the direct plan. It will amount to your money, all your existing investments being redeemed and new investment being made in the direct plan. So you will be liable for two things. One is any short-term capital gains that you may have, or long-term capital gains. So there might be a capital gains tax implication, and that is a one-time thing. You will be liable for that even in future. So you will be liable for that even now. It might be a good time because a lot of those capital gains might have vaporized with the recent decline in the market. So that's one. The other is that all your investments, most equity funds or balanced funds have, carry an exit load for redemption within 1 year. So your recent SIP investment will be liable for that capital gain, for that exit load. So that will be another thing to be conscious of. Maybe leave your 1 year old less than 1 year old investments lying in there, so that they become exit load exempt, and move the remaining money. And as your remaining investment, relatively new investment, becomes older, then move that money. So you'll be able to save that. So that is something which you should be conscious of, and that is how to do it. And it is beneficial that it will enhance your return on account of lower expense. DP Singh is asking that my daughter working in Walmart has been allotted some shares of a company as a part of her salary. Since these can be sold only on New York Stock Exchange, can you please advise on what could be the capital gains or income tax treatment on selling these shares? It will be treated as capital gains, and her principal investment, the cost will be treated as her income. And that capital gain will be liable, it will be subject to indexation. It will be treated exactly the way, if it is over 3 year old, then it will be treated like a debt fund. So consult she can consult the HR people of her company, because everybody, they will be expert at dealing with it. Every employee will have this issue to deal with. Dwarkanath is asking that you have published an article on how to profit from the upcoming crash. What is the likelihood of this crash, and if yes, are you looking at any time frame for the same? When markets have factored in Q1 washout, do you still feel that Q1 result can trigger the same? Assume COVID is contained. Let me tell you the little bit of dishonesty that we have done. 5-6 weeks back, this whole headline for the cover story came from one of my interactions here on the helpline, when most people, so many of you were asking that how to prepare, how much money they should they take their money out and invest once the market corrects. So everybody was waiting for that market crash, and this was just 5 weeks ago, and that is when we were actually planning the cover story of mutual fund insight. So we thought of I was just thinking of how to possibly suggest, how to possibly prepare ourselves for any calamity that will come in the market, and how to profit from it. Can we devise some mechanism? And that is what we have tried to answer. So my suggestion is that it has not worked out so far. I also spoke to many fund managers in the past week, and they were also of the same view, that the market is not crashing because there's ample liquidity, people don't know what to do with their money, interest rates have come down, and if this continues. But my deep belief is that if companies do not grow their earnings, if companies do not generate more profits, stock prices can go up, but go up to a limit, go up to a point, and after that, one fine day, there's some accidental coincidence trigger a market decline of a very severe kind, if it is not backed by real earnings of companies. So that can happen. I don't know when it will happen, and we have to see that COVID is contained, things get back to normal, things are beginning to get back to normal. But broadly, there are two kinds of businesses visible in the market. One, I would say three kind. One is that there are businesses which are not very affected, but they are a narrow set, the consumer companies and other things. And we have seen that many companies, they have not declined in value. And then there are essentials and commodity companies. Second set is that they have suffered, and they will recover, but not in a hurry. And there are companies which will be impacted in a very lasting manner. The cinema companies, or the airline companies, they can potentially be hurt, and they could be their financials or their ability to earn and grow again might have to wait for a very long time, or some of them might not be able to survive the whole declining phase. So in that sense, and then broadly speaking, market has been divided in two categories anyway. The companies which are doing well, doing okay, and the companies, but they are not growing, and that has been completely out of favor. There are companies which are yielding 7%, 8%, 10%, modest growth, good earnings, good return on equity, but they are not growing. They are not able to grow their earnings or grow their sales. Those companies are completely out of favor for a long time, and this crisis has only, accelerated the whole, they being driven out of favor for even more. Then there are companies, which can likely, register post, or post this crisis will get back to normalcy and start growing again. I don't know when it will happen. Until that happens, I'm not very apprehensive. I'm very apprehensive about when the markets will start rising again because of earnings growth. Until that point, I'm expecting that some combination of, like all roaring bull market, is never driven by one or two or three factors. It's multiple of factors: lower interest rates, rising earnings, rising demand. Everything is being very nicely in place. 5-7 things happen together, and the market grows in a sustainable way. We see a broad-based rally. We haven't seen a broad-based market run for a long time. That has to wait. I don't think that is coming anytime soon. And likewise, we can see a market crash or a market decline of a severe kind only if we see 4, 5, 6 bad news coinciding together, and somehow it happens. Most of the time we see those big declines, and until investors become very fearful. But so far what we have seen is that the money continues to pour in. So I don't know, it will happen. If we don't see earnings and the market keeps going up, that itself will be a good enough reason for the market to decline. Kyachidu Mo, I hope I have spelled your name correctly. I recently is asking that I recently subscribed to Value Research Stock Advisor. On the list, there is one stock which is only listed on BSE, and its trade volume is very low. Will there be any liquidity issue for this stock if I invest? If you are going to invest 20 crore rupee, then there might be a problem. But if you are, we look at those all the stocks that we recommend. There is a merit in some of these companies which are not very liquid, but otherwise they are very strong companies. And the opportunity there of owning or gradually building up a position in some such companies. So unless you are investing over 50 lakh rupees in such companies, you don't have, because even the low liquidity that you say is, I looked at the lowest trading volume in all our recommendations, and that was on an average about 45 to 50 lakh rupees of trade in a day, which I think is good enough. And even if you have a crore or 2 crore, you can do those transactions in 1 or 2 days. And such opportunities, such stocks also have greater propensity that once because of the lower liquidity or lower trading volumes, when they go up very sharply, and they also tend to be relatively more stable. But once the big earnings come by, these things tend to go ballistic, and we are hoping for that. S. Nagarajan is asking that what is VR's stake on ESG funds? Quantum has just started it, but more AMCs are expected to join. ESG is real, and it's understandable. Economically, environmentally sustainable companies, they hold promise, and this is in India among fund managers, it is in its very early stages, but globally it has become a big thing. A lot of funds pour into these ESG funds, and they are getting channelized, and it is affecting many companies. If you look at many good companies which are otherwise poor or on some variables are relatively low on this ESG scale, the methodology being followed. ITC is a classic example, a great company with such a long history, and foreign investors have exited this stock simply on account of environment issues or the ESG matrix that they follow, and it requires great deal, or many of the Indian petroleum companies. Look at their dividend yields. They're working, these companies are trying to persuade them that what they're up to in terms of being environment friendly. But still, they are, because it and so among foreign investors, foreign portfolio investors, it's a big thing, and it has already affected our companies. Companies which are low on the ESG scale are not being have been completely out of favor, or have been substantially deprived of the money coming from such funds, and those funds are big. So early days, and I think it's good for the humanity. So it should be good for the and it should align with the investors' need to generate superior return. And I think a good idea, find its taker, but early days in India. Nilesh Sabnis is asking that I want to create a corpus of 50 lakh for my daughter's higher education. I would need the money in 12 years from now. I also wish to create a corpus of rupees 2 crore for my retirement, which will be 15 years from now. Where and how much should I invest monthly to reach my target? Just go to Value Research Online, put these numbers and the time period. You will get an amount based on some assumption, which is typically 10 to 12% from an equity fund, and you will get the time period. So go to Value Research Online, put and find the outcome, and be disciplined about it. Start investing in multi-cap funds. Two things which you should be conscious of. First, look at that amount there, and once you have done that, make sure that don't wait for the last minute to withdraw your money. So once you need the money after 12 years, after 11 years, start taking out money for your daughter's first year education cost. While she's in the first year, withdraw the second year's tuition fee or expenses. So you are not waiting, and do it methodically. The way you do your SIP, that is how you should do your withdrawal too. So you will not depend on the market, state of the market at the last moment for your goals, for such crucial goals. You will not be left high and dry. Nitin Lodha is asking that Value Research Online is a very useful tool and source of information on investment. In my investment tool, will you be making available the option to add a recurring deposit with bank or post office? Yes, we have plans to add this as a feature in my investments. A lot of you have been asking for it, and we will have it soon. We will have it very soon. But you will not actually get you will get a recurring deposit provision, a provision to add recurring deposit, but you will have to provide the period of the recurring deposit, and because there is not a central repository of the savings rate, or it keeps changing, so you will have to supply us two more information, that what is the periodicity of your recurring deposit, and what is the periodicity amount and the interest, the coupon, because it changes, it varies, and it keeps changing. And it is not possible for us to actually have a central repository of the changing recurring deposit rates of various banks. So you will have to provide these three pieces of information, which is amount you are doing as recurring deposit, the period of this, and frequency, and the interest and it will get factored in your total net worth, and it will also help you calculate the tax on your interest. Paul Varghese is asking that kindly advise on the best performing fund manager and investment choice in NPS. I am 56-year-old. I haven't done a very close analysis of all the NPS funds, but at Value Research there is a NPS performance tracker, and take a closer look at that. But I will use this opportunity to tell you that we will do a special coverage of NPS performance, and get back to you with the best equity and debt fund manager sometime in future, and soon. I think it's a good idea. I'm taking this idea suggestion from you, and we will get back to you, and we will use it as a feature in Mutual Fund Insight as well as on the website, and maybe we will see that how we can actually put the outcome of our analysis or review or closer look into the performance table of NPS plans for you on an ongoing basis. Rudresh is asking that Value Research is doing so much of good things by educating retail individual investors. Can you please add rolling returns also for mutual funds? We are considering it. It is becoming a very data intensive exercise because it has to be updated. But we are considering this to as we will. There has been a very wholesale change in the way in our interface at Value Research Online. Soon we will be making a big change once again in about 3 to 4 months time. We are working at it, and that will make it even friendlier and far more powerful in your ability to plan things, execute things, monitor things, and also learn things. And it will also become a little more stylish or much more friendlier. So that is the effort. Maybe I will share some preview of that while the work is on for all the regular users of this. But yes, we plan to add the rolling return, particularly for the debt fund, where it should be a very significant input in your decision making too. I think it's a useful thing to have. Satish is asking that why are AMCs consistently increasing the expense ratio? You being SEBI board member, please try and protect the retail investors. Thank you for wonderful and knowledgeable live sessions. I'm not a SEBI member. I'm part of one of their advisory committee, and that meets often. It contributes to it, but SEBI members are they are the decision makers. SEBI has a board, and why AMCs are consistently increasing the expense ratio. But mind you, if you remember, just about 8 months back, or maybe a year ago, 8 months back, SEBI reviewed the expense rules that we had for all mutual funds, and expenses got reduced substantially, quite meaningfully. In fact, and not only expenses got revised, for the regular plans, the expenses were also, the distribution or the commission to be paid to the distributor of the regular plans of mutual fund. There was also a law which will drive some good conduct, because investments, the distributors will be entitled only for the trail commission. They will not get upfront commission, and that will drive a good behavior. They will actually go about selling mutual funds correctly or better. Their interests were better aligned. Why do funds actually increase expenses? Simply to make more money. The higher the expense, the more the profits. But SEBI has gone about doing things to reduce the expenses, to rationalize the expenses, to make their expenses more transparent. In fact, expenses are now visible on a day-to-day basis. In case of mutual funds, equity funds are a different story altogether. 10 basis point, 5 basis point, and there could be a justification for superior performance. If you create great performance from an equity fund over a full market cycle, 10 basis point extra expense, of course it is higher, but it can may be well worth it. In many cases it won't be. In fixed income fund, it doesn't work, because expense is a very significant part of the total income or the return generated by the fund. So expense itself becomes one of the significant differentiator for a debt fund. I would like the funds to be far lower expenses, having far lower expenses. Not only that, investors should be able to choose things, but investors don't choose based on, still good amount of fund is being bought, sold by intermediaries who are a beneficiary of the higher expense, because they also get commission. But in some cases, higher expenses, marginally higher expense can be justified. But as you will see, there is a pressure coming from different areas. One is the ETF and the index fund, which naturally have substantially lower expenses. The access to the market for intermediaries, for investors directly, making these ETFs accessible in a more democratic way with far greater ease is becoming a possibility. So, and if a fund manager is actually charging expense and is not able to beat the benchmark or give you superior returns over a full market cycle, investors walk out. You vote with your feet. You get out of that investment. So exercise what you have in your control. SEBI has gone about lowering the expenses. It can be lowered even further. In debt funds, The marketplace is far more, dynamic in terms that, mutual funds never hit the ceiling. In case of equity fund, they hit the ceiling because they can. And if investors ask more questions or move their money because of expenses, but the role of expense in the total return generated from equity is so insignificant that this is a catch-22 situation. Investors won't get out, and fund managers won't reduce the expenses. And the SEBI rules, despite getting tightened, still are, quite meaningful expense. And the other option you have is the index funds. The other part you said that, I'm part of SEBI. Yeah, in a certain way, I'm part of SEBI. I'm able to contribute to that, and I definitely voice my view on these fronts. I take up all these issues which I think is paramount for investors. I'm the only. I try to put the strongest voice for investors in that committee. Chandra is asking that from an NRI perspective, if someone can put 1.5 lakh per month aside for mutual fund investments and the time horizon is more than 10 years and he's aged 45 and no immediate cash requirement, what are the options available? Existing investors are in, my existing investments are in real estate only. For 1.5 lakh per month, choose one or two good equity fund. Multi-cap equity fund, keep doing it, and I think it will translate into something substantial if you are regular with it, if you don't get distracted, if you continue your investment continuously for the next 15 years or next 10 years, it will translate into something substantial. Of course, you just have to make sure that whatever be the situation, because markets, you will see one or two market cycles during these 10 years. Markets will get very excited, or it will multiply many times, or it will crumble by 40-50% in a brief period of time, and that is the time when most investors are driven out of the market. Stay the course, draw a plan, and review your investments every year. Pradeep Kumar Gupta is asking that how does a debt fund handle the liquidity issue in a best possible way? Why could Franklin not handle it well? Also, why is SEBI so adamant about the limit of 20% borrowing only to handle the redemptions? Debt fund handle the liquidity issue in multiple ways. One is by constructing their portfolio in a manner that they can liquefy their portfolio. They can sell a good part of their portfolio. But at the same time, different objectives, different debt funds, different kind of debt funds. They have different framework to operate in. For example, ultra short-term debt fund will work in a different way. Liquid fund invests all the securities which is can be liquidated in maybe a few days' time. Or overnight fund naturally expires every other day, so it is in overnight securities only. So likewise, short-term debt funds can have maturity or securities. The real problem, why did Franklin happen? It is because 5 bad things happened together. One is that Franklin, all the funds had credit exposure. Then COVID happened. Then we had the beginning of the debt fund crisis, which was continuing for the last 1 year. And after that, we saw extreme risk aversion. The debt fund, corporate debt market dried. There were no buyers, only sellers. Franklin was also the most inappropriately placed, because of the credit market investments, investment in corporate bonds of companies. Franklin was one of the biggest players. The total size of the market was 1 lakh crore, and Franklin had 50,000 crore worth of investors' money invested in those bonds. So Franklin was half the market, and other half was also facing the pressure. There were no buyers on the other side. It was almost like the underlying market of the securities invested by Franklin got frozen. So that was an extreme situation, and SEBI has provided for 20% borrowing only to handle the redemptions. This is the law. This is the prudent thing. In normal conditions, 20% is good enough, because if SEBI allows 100%, then the fund will have a sizable borrowing. It will have no investors' money. Even this 20% is, to my understanding, in normal situation is very high, because these borrowings will have an interest cost. Investors will have to bear the interest cost. SEBI laws also prohibit mutual fund companies to charge interest cost more than the return on the fund, which means the fund companies themselves will have to bear the cost of the borrowing to honor the redemption. We should not forget one thing, that mutual fund is a pass-through, and that is the spirit which should be enforced. Unfortunately, there is a huge gap between the way debt funds are designed and the kind of dissonance, or the kind of arbitrage it creates. When you buy a debt fund, you can redeem your investment and get your money back anytime. You can turn up at a fund company and ask for that. But when the fund company is investing your money, it cannot redeem its investment. It cannot call its investments that it has invested on your behalf exactly in the same manner as you can take your money out. They can't pull the money out. They cannot ask the promoter whose bonds they have bought, they have invested in, that give my money back because my investor is asking for money. And when they can't do that, because bonds have maturity date, they carry higher coupon if the maturity date and the credit quality is lower. And that is what happened to Franklin. So mutual funds off late, ever since the Franklin crisis, I spoke to all the fund managers who are running their corporate debt fund. They have gone about creating different kind of liquidity. One is that ICICI Prudential has gone about getting a permission to have 35% investment in money market funds and government securities. So having 1/3 of the money in highly liquid securities is one way. Ability to borrow and having a credit line ready is another way. Even the ones which are long term but more liquid securities, because going on a higher credit rating, because superior credit rate, bonds having superior credit rating, it might it might have a superior liquidity as well. So these are things which funds this is how they prepare themselves for higher liquidity. At the same time, but I can tell you that if we have a situation, the kind of bad coincidences that happened at the same time for Franklin, it will happen again, because if a lot of investors turn up to take all their money again, then all the securities cannot be sold at that instant, and more so at a point when the context will be, or the situation will be really grim, that even the underlying market will not be able to absorb that kind of investors need for liquidity. So we have good amount of checks and balances. Calamities happen, and it will happen again, and we have to see how best we are able to mitigate. And right now I find that there is an even greater risk aversion. If you look at the corporate debt funds, their return is perhaps last month has been one of the best months for them, simply because they were so poorly priced. Everybody was so risk averse. Everybody was willing to sell it at any price. Their price really went down to such levels that they have made a significant comeback. So it will create aberrations. It will create opportunity. It will create havoc, and you have to see on which side you are. Maybe for investors, the lesson to take is to diversify, keep away from extreme, funds taking extreme positions, and that's about it. Kim Reddy has asked, and this is the last question, that I have invested or rebalanced my portfolio during March 20 as per our inputs. As per inputs given in your article, The Ultimate Portfolio for a Retiree, on 1st of January 2020. Okay, 1st of January 2020. I'm unable to recall that, the precise date of this article, but do you suggest any changes considering the current critical situation, or I should stick to the same portfolio and rebalance yearly once? Oh, Mr. Reddy, congratulations. You are a big beneficiary of following my advice, which is a great coincidence, because if you did the rebalancing in January and the crisis happened in March, you had realized a modest part of your of your gains. I would like to give you one more suggestion. My understanding, rebalancing is a very useful tool for most common investors, because all other things are it's very difficult to, ideal thing will be if we are able to time the market perfectly, but it is an impossible thing to do. The next best thing is, being able to rebalance, so that you are able to take a part of your gains or able to invest a part of your money which is in fixed income into equity in a more opportunistic way when markets swing in a wild way. And so my suggestion for your rebalancing is that in normal conditions you should do your annual rebalancing and reset your asset allocation. But you should periodically look at your, set up your portfolio at Value Research Online. Look at your asset allocation based on all the investment that you have made together, and you can look at the aggregate asset allocation. If your asset allocation goes out of whack, you have chosen to be 50% equity and 50% debt, and suddenly if you log into your account today and if you see that your asset allocation has become 60% equity and 40% debt, because equity has gone up and fixed income has not gone up at that pace, maybe it is time to rebalance. Because if you put a number on at what alteration of your asset allocation you will rebalance, because if you keep waiting, the opportunity will go away. So, and articulate these rules in your mind and note it down and keep it on your desktop, on a pinup board. Because if you decide that it will be 50-50, then do your rebalancing irrespective of whether it has not, even if it has not been 1 year. If it turns out to be 55-45, if it is in a nominal range of 55 within 55-45, then don't do any change. And every year definitely do that rebalancing. But if it turns out to be 53 and 47, you don't need to do anything. Only when your asset allocation goes completely very different, it's an opportunity. Moving your money from equity to fixed income or fixed income to equity will be meaningful. If you're doing for a 1%, 2% change in allocation, rather do not do it. And congratulations once again if you did it in January. Look at it as asset allocation again, though it is little early, but it might be, your allocation would have changed very dramatically. It might be a time to rebalance. So thank you very much. And I took 20 questions, and I'll come back again next Saturday.